Hi, everyone, again. Sorry about the technical problems, but we're here. That's what matters. And, it's great to have Jay again, especially, on a volatile day like today. It's great to hear your insights. So I'd like to go straight, to the title of the musings of your monthly, which is transitions. So, of course, transitions are by definition, very unsettling and trying times. So can you tell us what's going on, which transitions we're in, and then we can, we'll follow our usual process.
Sure. Sorry about that, folks. And hello again, Roberto. And good to chat with everyone, as always, on these Home Research live sessions. And certainly we have an interesting time period we're in today and over the last week or so. It really is, I think, unsettled market conditions is a fair description across really across the assets, right? So not only equities, but commodities with some of the price moves we've seen in the energy sector, following on, months of activity like with lumber and iron ore and other things. So we've kind of seen this volatility, but it seems to have kind of consolidated and really gathered a little bit in strength here, certainly over the last week or two, and of course in the fixed income markets as well, with rates backing up and breaking out of the range they've been in really since the spring. So I do think we're in multiple transition periods. Transitions, by definition, as you point out, are unsettled in unsettling times. Things are in flux, and I think it's important for investors to try and not get distracted or overwhelmed, and really keep your eye on the strategic focus, the direction of travel, so to speak, and not the multiple now potholes that we've hit over the last couple of weeks. And so I think that's, thinking tactically, thinking strategically, and then thinking about the transitions. Maybe the way to go, Roberta, would be to talk first about kind of the tactical outlook, then talk about the strategic outlook, and maybe then, if it's okay with you, get into the transitions, because they are kind of longer duration, longer tailed issues. And I think setting up the tactical and the strategic outlook might be a little bit might be an easier way to enter into that discussion.
Fantastic. Yeah. So let's go. And we're just talking about the tactical. So, talking about it, as we we're chatting before the call, it looks like, the market is pretty much oversold, right? I think, there's been a lot of selling for different reasons over the last, month or so, over the last 5 weeks. So, how much more selling is there to come? And where would you be positioned, in this environment?
Well, yeah, if I knew the answer to that first question, Roberto, I'm not sure we'd be talking. I'd probably be, sipping margaritas out on the beach. But
that's right.
I do, tactically, first of all, to probably set the stage, for me, tactical is the next couple of months. So really, let's think about into year end. And I do think that we've had a cascading series of kind of fears that have provided plenty of opportunities to sell. And I go back to several months ago, the Delta discount of mid-July, right, which I've made a big deal of over the last couple of months, saying that was the point when the market fully discounted Delta and we weren't going to go back to those levels. And then we had the China edicts of President Xi in middle of August, which caused another opportunity for selling. Then we had the Evergrande several weeks ago, right? And then last week we had kind of the confluence of supply chain and energy price shocks coming together to create a pretty, together with the end of the month, end of the quarter, normal kind of rebalancing and repositioning, created, quite a downdraft in the equity markets, where the S&P had its worst week in 4 or 5 months. So to me, I think there have been plenty of opportunities to sell, and you raise a very important point. The end result of that is that for the first time in over a year, the S&P is in an oversold condition, and in addition, the Nasdaq, the triple Qs, also have now entered in an oversold condition for the first time in over a year. So I do think an awful lot is in the price. And I do think that importantly, I don't know when the selling is going to end. I wish I did.
Yeah.
But I do think the way I approach it, at least, is to say, okay, what are the factors creating unease and desire to sell, and then what are the offsets to that? And I do think it's important to note that there are, I think, some pretty significant offsets. One of which is seasonality. October is known as the bear killer month. And people who do analogs, seasonal analogs, technicians, tend to say that we're probably pretty close to the nadir, the bottom of this current period of weakness. So seasonality is better. That's important. Delta is fading. That's probably the most important. Clearly, not just here in the U.S. or in Europe or in South America, but really pretty much globally, it's fading, and there's no other major variant coming behind it. That is leading to what I've been talking about over the last couple of weeks, the Asian reopening, which continues to unfold. Japan has lifted its lockdowns. You have a situation where global airline departures are at their highest since the pandemic really took root in the spring of 2020. So the Asian reopening trade is underway, and the growth lull, the kind of Q3 slowdown in growth, I think is also ending. Even though the headlines are still talking about slowing growth, if you look at the ISM numbers that came out in the U.S. last week, if you look at the city economic surprise index, bottomed several weeks ago and is turning up pretty meaningfully. And you have a situation, I mean, it's really interesting. You have a guy like Gary Schiller talking about, in a piece in Bloomberg today, and I don't mean to pick him out necessarily, but, there's a piece talking about how shipping costs have skyrocketed because of the supply chain interruption. But then there's also work today that comes out, media reports out of China that say that the cost of shipping from China to the U.S. has fallen between 25 and 50% over the last several weeks as we move out of the peak shipping season to get stuff over to the U.S. in time for Christmas. So COVID speed, that what we've talked about for a year or more, continues to unfold. And so you can have two kind of headlines in the same publication, one saying shipping costs are soaring, the other, more timely, saying that, in fact, no, they've halved in the last couple of weeks. So all that's to say that we had a pretty ugly September. AcquiX outperformed the U.S., by the way. I think that's something worth noting. The non-U.S. markets outperformed. As you know, we've been recommending a overweight of the non-U.S. equity markets. Commodities did very well, had one of their best months, led by the energy sector. As you know, we've been quite constructive and bullish on energy, both fossil and new energy. And so tactically speaking, I think we're probably closer to the end than to the beginning of this sell-off. But I have to also say that I've been surprised by the persistence and kind of the aggressiveness of the selling. And we saw that again today, where without any kind of move in the rate markets or anything, technology got absolutely hammered, with a lot of things down, 3% or more.
Yeah, I mean, of course, today that was the outage at Facebook, but the selling was basically in the first hour, before this was an issue. So, no, yeah, I agree, and it seems that really, what seems to be unsettling people is this whole energy crisis. I mean, of course, the UK is very much an isolated issue because of some of the Brexit consequences. But I mean, how before we move on to the strategic, how do you see this whole energy theme playing out? I mean, it's is this part of the same disruptions to supply chains, and how should that when should we expect that to end?
Well, I think it's a great question and a key question, and I'd recommend to folks who have access to it. JP Morgan put out some good work over the weekend talking about exactly this issue, and raising the question whether it was supply related or demand related, and whether it's going to lead to stagflation or more inflation pressures. And they kind of came down on it's a mix of both supply and demand issues. Obviously, as you point out, the UK, one could argue that the real issue in the UK is a shortage of drivers to drive the fuel trucks around to where it's needed, which is directly tied to Brexit, as opposed to anything beyond that. But that's not quite the full story. As we know, when you look at the Dutch gas market, which is the main kind of European-wide gas pricing model, it's, gas prices, natural gas we're talking about, not gasoline, is up, well over 100%. And so part of that is destocking over the course of last winter, failure to build inventory because people weren't sure how strong the economy was going to come back. Economy coming back in Europe, particularly in the last, 3 to 4 months, stronger than expected. Issues around Russia providing gas to top up supplies because they wanted to start the Nord Stream 2 pipeline. There's a whole host of issues. China, there was a big headline that came out of China, I think either Friday night or on Saturday, talking about how they instructed people to get coal supplies at
whatever
any
price,
effort, whatever. And the thing is that it's like Evergrande. Evergrande, the current short, what happened to Evergrande was the government started to get focused on limiting the risk in the property market. So they set out the 3 famous red lines, which everybody's already talked about ad nauseum. So it was government inspired. Here too, a large part of the issue in terms of energy supply in China is government related. They mandated that plants shut down to provide cleaner air for the Winter Olympics. They're trying to bring down their energy consumption and their usage of dirty fuel to start to decarbonize their society. And so the idea that they have to go out and get energy supplies at whatever price required is, on the other hand, they're just going to simply say, okay, coal mines produce more coal. And that's doable. Just like they can say to Evergrande, okay, the different entities ring fence Evergrande, which looks like it's going to be the way that plays out. And different people, different entities, take pieces of Evergrande, and gradually you don't have any one big, blow up. It just gradually gets pieced away, and the markets forget about it and, start thinking about something else. So I'm of the view that first of all, for us, thinking purely portfolio wise, it's good for our carbon position because as a result of a shortage in natural gas supplies, you are having to burn, more oil, more coal, and therefore carbon permit prices go up. And the carbon exposure that we have in the ETF space, remember, it's our single biggest climate-related position in our TPW20 global thematic model, and in our global multi-asset flagship model, it also is one of our biggest positions, and that continues to power ahead and set new highs almost on a regular basis. The other point I'd mention is that there is going to be, because gas has become so expensive, switching from natural gas to oil, and therefore firms like JP Morgan and others are raising their oil price targets. Brent, I think JP Morgan this weekend raised their Brent target for year end to $85. And so, there again, we have been very bullish all year and since last year, pounding the table on the opportunity to make money in both fossil fuels and clean energy. And so this is something we think is going to be a long-standing theme. There is the drive to decarbonize. When you're talking about transitions, the biggest single transition of all, overwhelming everything in the market, is the transition to a low carbon global economy. And so this issue of fossil fuels pricing and carbon, et cetera, is going to be with us for the foreseeable future. And I think there are the issues around lack of new projects for coal mines, gas, oil fields, etc., not being financed because of ESG concerns. We have to move in that direction. And in a way, if you want to be thinking the positive silver lining is that the price rise here is going to drive further and faster adoption of low carbon energy sources, which then, of course, has issues with the supply side of the things that are needed to facilitate that, right? The silicon or cobalt or lithium, or, we can go on. But I think it does mean that investors, need to be on their toes, need to have that strategic, outlook that I talked about at the beginning in unsettled markets, and take advantage of when the market is, because of dislocation, going to throw stuff out. If you have an opportunity to buy, and I'll give you one quick example before we maybe move on to the strategic environment, and that's Japan. Japan today, EWJ was down 3%. It's off 9% from its high of 2 or 3 weeks ago. Why? I have no idea why. I mean, I think it had a nice little run finally after doing nothing for 9 months this year. It was absolutely flat going into, August. And then it had a big pop as the prime minister resigned, and talk of a new stimulus package, and finally getting COVID under control, et cetera, et cetera. And it had a pop, and then boom, lo and behold, that pop has been erased as people have decided to take what profits they have in the unsettled environment that we've witnessed in the last couple of weeks. But to me, that's an opportunity to step back into something like an EWJ, like Japan, because nothing's changed on the fundamental case that makes Japan attractive. Delta is fading. New government is going to bring a significant fiscal stimulus package to the fore. I've read somewhere up to could be as big as 5% of GDP. So quite a meaningful size package. Japan is a cyclical play on the global economy and on Asian reopening. It itself is reopening. Japan is the only major economy in the world with a composite PMI of under 50, because they've been in such strict lockdown for so long. It's the only economy that's going to grow faster in 2022 than in 2021. Earnings outlook is very robust. Foreign ownership it's underowned. Valuation is very compelling relative to the rest of the world. None of that's changed. And if anything, that there's been confirmation. We now have the new leader of the LDP, who's probably going to be the new prime minister when they have the elections at the end of the month. The lockdown has been eased. The stimulus package is coming, and yet it's sold off literally 9% from the high of 2 weeks ago. So that's the opportunity that, when I say in unsettled market conditions, investors need to kind of have that strategic outlook. And when they see opportunities like that getting sold off, because people did make money and very quickly, right? It had a big pop, so you can take that profit and go if you're more of a trading mentality. If you're more of a longer term investor, like we are at TPW Advisory, you either you highlight that to people, as we're doing here in the live session, or you hold, at least in our case, we are overweight Japan, have been overweight, and are holding that overweight. But to me, there are opportunities like that brewing in the markets, and that's something that investors can take advantage of.
Yeah, and talking about Russia, talking about oil and energy, I want to highlight, what you said last time, about your bullish call in Russia that you have added to that. I mean, and of course, I'm asking this in the sense that, would you increase positions in Russia? You think that, with the upcoming Nord Stream negotiations, you think that would mean further upside to the market? Because we had some people asking about this.
Well, we did initiate a position in Russia last month in our portfolio update. So almost a month ago, because it's that time to do that in the next couple of days here. We'll do this month's version of the portfolio. So we did add to Russia, and we added to Russia as a way to kind of play the backdoor energy shortfall that was becoming visible in Europe even 5 weeks ago. And Russia, the RSX, the ETF, is 36% energy. It's probably has one of the biggest energy holdings of any ETF out there that's not 100% energy focused. And so we like it for that reason. We like it because emerging markets have been big underperformers. We like it because emerging market is a big underperformer. A couple of weeks ago, I forget when we initiated, I made the point that EFA was up about 12% year to date, and EM was up 2%. Now I think probably EM is flat to down, and so there's no, investors' interest has been quite low, and Russia valuation-wise is very, very compelling. The currency, as you might think, as an energy exporter, is quite stable, and maybe even stable to strong. So you're not going to be at risk there. So there are multiple reasons to be supportive of a position in Russia, and we haven't gone through our portfolio for the coming month yet, but certainly I don't envision us selling the Russian position anytime soon. And if it sells off during this dislocation period, then I would encourage people to take a look at it. Absolutely.
Yeah, no, great, but it doesn't look like it will, and yeah, it's been a great call. And then before we move on to the strategic, there has been a discussion here, and I just wrote an article about this on people blaming ESG and blaming the energy transition for what's going on in gas prices. And of course, we were just chatting before, and we know that's not the case. My question would be more in the sense that, do you think that something that we talked about last time, could be a force, which is the climate populism. So the same thing that drove the yellow vests in France, something of that fashion, coming back and even being present this year. Although governments have, they are smart about the issue, and they'll be subsidizing gas prices. So do you think people could be attacking ESG, for, of course, totally the wrong reasons?
Well, I don't. I think that's a big question. So a lot to unpack there. I guess I'd start by saying first, as I've mentioned many times, but it always bears repeating, climate is the single biggest global macro trend of this decade. Full stop. And therefore, investors need to be understanding it and paying attention to it and investing and positioning in it if they want to be successful as investors over the next decade. And so that's point one. Point two is you brought up the fact that governments are going to work to alleviate the concern of rising energy prices on the populace, which I think makes sense. And that's a very important point, because climate, like COVID, is going to ensure that that government plays a bigger role in the economic life of pretty much every economy for the next decade, right? So we are in an era of big government, and you need government to tackle COVID. That's clear. You need government to tackle climate. You and I can't do it ourselves. Individual companies can't do it themselves. It's going to have to be government, public-private partnership to drive this forward. And there's some really interesting things going on. This is a little bit of a digression, but really interesting things going on in terms of the demonstrated capacity for technological innovation to be put into play, and then the cost of that innovation being driven down through repetition and expansion of utilization. It's called Wright's Law, not right is with an R, but right with a W. Wright's Law. And it basically says that the more you do of something, the faster the evolution and the lower the cost. And so you look at solar panels as an example, completely collapsed in price over the last 10 or 15 years. You look at the price of a lithium battery for an electric vehicle, the cost curve is like straight down. My hand is probably not giving the best illustration of the curve, but it's straight down. And so the more that we do of this, the cheaper it becomes and the faster of the adoption. So there's a big push going on now to actually accelerate the adoption of low carbon energy issues, both on the power side and on the transportation side. Those are the two keys, right? Power generation and transportation. And so I think this is fascinating stuff. And as I said, I spend a fair amount of my time thinking and paying attention and trying to understand where this is going, because again, it's going very, very quickly. And the ESG element of kind of driving the financial sector in particular to not support via financing new coal mines, for example, or new oil fields, for example. That is a fact. And if we want to get to a low carbon world, if we want peak carbon by 2030 and a net zero by 2050, then this is what has to happen. And so in a way, we're forcing the adoption. Price is what moves the needle, right? You can say, oh, we should decarbonize because it's good for us. And that's not going to do anything, even though, well, just look at COVID, right? And 20-30% of America doesn't want to get vaccinated, even though they run the risk of dying. So the fact that you can say, we should decarbonize because it's good for the environment, that doesn't cut the mustard. So now you're having governments step in and forcing the issue. And I think we're going to see more of that with carbon taxes. You and I have spoken many times about carbon border adjustment mechanisms in Europe and perhaps in the US. It's becoming a bigger and bigger issue in the United States as the Biden administration tries to find ways to, raise money for its human capital plan. So to me, this is all part and parcel. I don't think the current situation, the last week or two in Europe, gas prices, I don't think that's ESG related. I think it's a combination of factors, as we've spoken of a few minutes ago. But I do think it is clear that we are not going to be digging new coal mines. We're not going to be searching for oil going forward. It's going to be, and so I think again that means that most likely the price of these things are going to go up, which is a explicit catalyst for moving to a low carbon environment. So as I said before, if you want to be a silver lining about this, this is going to accelerate the adoption of low carbon energy. And there's going to be some, it's like making an omelet. There are going to be some broken eggs. There are going to be some challenges to do so. Of course, we're talking about, transforming the entire global economy. And so this type of disruption, I think investors are going to need to have to get used to it. I do think, as I've said, we have been participating in this for well over a year now. At this point, we're now in October. We were talking about this in the fall of last year. There is an opportunity to make money as an investor in both fossil fuel, because it's gonna go up in price, because we're not going to be finding a lot more of it. We're not going to be searching. We're not going to get funded to do that. There's an opportunity in the service providers, because there is going to be a lot of effort in getting more out of what's already been built up. And then, of course, as we've talked about many times, there's an opportunity to make money in the clean energy, in the carbon, in the electric vehicles, in things of this nature, in uranium for nuclear power, which I think is increasingly going to be seen as a way to kind of square the circle. The nuclear plants that were slated for kind of going out of operation are probably going to be extended. There's probably going to be new power plants being created via nuclear power to provide that base load. Because part of the problem is that when we have the energy spikes and then wind doesn't blow as much as it has. I mean, part of this issue is that the wind off of the UK has not been as strong as it usually is. I mean, that seems kind of hard. It's almost like when a butterfly flaps its wings, all sorts of things happen, which I've never really been able to wrap my head around. But here, it's actually what's happening. And so it shows you the fragility a little bit of the system, and that's going to have to be dealt with as well. But to me, it's not a surprise. This is the single biggest global trend of the decade, climate and the transition to a low carbon environment. And it's something every investor needs to be paying a lot of attention to. And I think it's going to be one of the key ways to add alpha to portfolios. But again, when you have these kind of price moves and dramatic price spikes, obviously it's very tricky and very dangerous. You can get really chopped up if you buy at the wrong time or sell at the wrong time.
And I mentioned this because we have a question from the audience here. So, are you a believer in? I think we talked about this in the nuclear story, so in the uranium story. So, there have been comments about the French finance minister today about the cleanliness of nuclear. Would that still be part of your I would say thematic or commodity allocation?
Yes, full stop. It is. It has been, and it will continue to be. And again, the price action there has been not really because of any increase in demand, but more because of some changes in market structure, where a Canadian-based company developed, introduced a new product to hold the physical uranium and to buy at the market. So raised money to basically buy uranium, physical uranium, at the market price. And it exposed what has happened also in Europe. Most of the the electric utilities have long-term contracts with the supplier of the energy. And then they top up those long-term contracts by going into the spot market and buying whatever they need for like the remaining 5% or, what, I'm not sure exactly what the numbers are, but the bulk is in long-term contract. There's a little bit that is done on the spot market. And the spot markets obviously are what's going haywire and driving the price that you see when everybody shows you the hockey stick chart of, natural gas prices in Europe. That's the spot market being disrupted because of some of the things we've already talked about. In the uranium market, it's the same thing. You've had a big move in the uranium price, but it's because of a particular market participant going in and buying up paying up higher prices for the spot market. In the utilities, who have had this uranium market to themselves for well over a decade, right? Because it's been since Fukushima in Japan, back in I think 2011 or 2012, there's been absolutely no interest.
March 2011,
no interest in uranium. That was basically the death knell of the nuclear power industry. And so they've gotten very used to being able to go in and buy at the spot market, which typically, because there's been no interest, the spot price has been going down. And so they've been playing a little game. And now all of a sudden the game has been, a new player has come in and completely disrupted the market. And so we own URNM in our models, both in the thematic TPW20 as well as in the global multi-asset. So that's the way we're playing it. And again, it's had a huge move. It's had a dramatic pullback. But I think the net of the whole issue is that is not being driven at this point by supply, demand for more nuclear power. That I think is coming. And that's why we're holding it. We've been fortunate in that we've been able to benefit from some price appreciation because of this new physical buyer, which I mentioned. And so I do think there is going to be, in all these markets, there's going to be some resetting of expectations about how to position, how to supply. All these things are going to increasingly be open for discussion, so to speak. And I do think that what we've seen in the gas side and what we've seen in the uranium side is some folks who got very comfortable, buying on the spot market in lower prices than their long-term contracts, have now seen that flip to spot prices being dramatically above, and therefore they've gone out of business. As we've seen, the number of small utilities in the UK have gone out of business because they got that mismatch wrong. But that's like in the markets, you have people, their trades got mismatched and they're out of business.
Yeah. So yeah, no, it's great. So before we move on to the transitions, I mean, you talked about Biden wanting to finance its human capital plan, and couple of questions. One is, how do you see that going? In the midst of this, debt, ceiling saga, and there has been the release of the Pandora Papers. So you think, big taxes on the 1%, could be on the way.
Um, I do think that what's going on in Washington is really very interesting over the last week or two. And I do think that it's constructive for an eventual deal. Here are a couple of things that have struck me. First, the progressive side of the Democratic Party has demonstrated its ability to kind of stand firm versus a strong push by the center moderate part of the party to cave on their demands. So they have demonstrated strength. Secondly, they've also demonstrated a willingness to forego the $3.5 trillion price tag. I think it's been a big mistake by the Democrats, and I think they're increasingly recognizing this, to allow the price tag to be the lead for any discussion about this, as opposed to all the important things, at least from a Democratic perspective, Democratic Party perspective, that they think are going to be achieved by this human capital plan. My focus has been not so much on the social policy part of the human capital plan, but what it means on the climate side, right? Where there is the big bulk of the climate package for Joe Biden is in the human capital infrastructure plan, particularly around clean electricity standards, as well as around electric vehicle charging system nationwide, and electric vehicle subsidies to drive electric vehicles to become 50% of the fleet or 50% of new car sales by 2030. That is in that infrastructure plan. And therefore, that's what I have been focused on, because those two things, I think, are what gives the U.S. the only chance it has to make the 2030 peak carbon Paris Accord targets. So, and I've spoken, and we've spoken, and I've written about how climate speed telescopes time. So when you think in the U.S. framework that maybe the U.S. has 9 years to meet the peak carbon target, it doesn't. It actually has like a month or two to pass this, which then provides the opportunity to make the target. If this is not passed, then the U.S. capacity to meet the Paris Accords is virtually nil. So those are a couple of points. The other third point I'd mention is that Nancy Pelosi has set a firm date of October 31st to vote on the physical infrastructure plan, the bridge, the tunnel, the port, the $1 billion one. Okay, so now it's very clear, and Joe Biden said over the weekend, the two bills are intertwined. You're not going to pass one without the other. And that was always the progressives' position. They would not go along with the physical infrastructure plan unless there was a pretty much guarantee that the human capital plan, which has a lot of the social parts that wing of the party is most concerned about, that's where those parts sit. So we now have kind of almost gone back to where we were a couple of months ago. The two bills are intertwined. It's not going to be one or the other. It's going to be both or none. The progressives have demonstrated strength as well as flexibility by saying it's going to be less than $3.5 trillion. Pelosi has set a firm date, so we now know it's going to be the next month, October 31st. I don't think that date can slip because there's some things related to it that would be very prohibitive. So that's a firm date. And I think that the Democratic Party has been able to kind of keep all of this going within, a very narrow window of votes. And so that my feeling is that it's more likely, as a result of the political back and forth over the last week, that we will get both bills passed than it was a couple weeks ago. So net, that's a positive. I think it's a positive for the country. It's a positive for the potential to meet the Paris Accords, and it's a potential for the Democratic Party to maintain possibly its majority in the House in the 2022 elections, because I think it's clear that the Democrats are going to have to run on a on a we get things done, things that help you directly platform, and that was COVID and these bills. COVID that message has been obviously tarnished by Delta, and it's too early to say that the getting things done through the legislation that it's upcoming has been lost, because it hasn't happened yet. But if it's passed in the next month or two, that's plenty of time to be able to drive that point home repeatedly between November 2021 and November 2022. So that's the way I would see that playing out. I haven't really thought about the papers, the release there. I do think there's the Democrats made a big mistake allowing this to be tagged as a $3 trillion bill and let people say all sorts of stuff about it's unpaid for, this and that. I mean, the bulk of it is paid for. There are tax increases of different types, most of them on the wealthy who have benefited from the Trump tax cuts, and the corporations likewise. If you look, the corporate take in the United States, the percentage of the revenue raised in taxes in the U.S., the percentage that corporations pay has completely collapsed over the last 20 years. And so that's going to be one clear area where the tax rate is going to go up. I do think there's, taxes, stock market has been phenomenal over the last couple of years. The wealthy who have the most invested in the market will pay more. But I don't think it's going to be crazy, because one of the important things to remember is that equity positions now are much more important to household net worth in the United States than they have ever been before. It used to be that the bulk of one's net worth was in one's house, and that's no longer the case. The one's portfolio value is now higher on average than the value of one's house in terms of total net worth. And so I don't think that's one of the reasons I think why the capital gains tax discussion has been kind of set aside, at least the very high end capital gain tax discussions, because they've understood that it would be affecting a lot more people than they probably first thought it might.
No, that's great. And now, final 10 minutes, let's talk about the transition. So, let's see if we can, tackle them with, the time that we have left.
Yeah. Wow. I mean, that is a super fast. I think that's the fastest I feel like it's ever gone. I didn't realize we were anywhere close to 10 minutes. Okay. So let's be real quick. So first we want to talk about the strategic outlook and then the transitions. Okay. So we talked tactical next couple of months, through year end. I do think there's still, it sounds crazy, but I do think there's still a possibility of a pretty aggressive run up until the end of the year. So that's just one thing I want to remind people. But strategically, so here looking out 6 to 12 to 24 months, the big strategic thing to keep in mind is that I do believe we're on the cusp of the strategic global expansion that I've been talking about for some 6 to 9 months. I thought it would come in the second half of this year. Delta has obviously delayed that, but now with the Asian reopening, we have Europe, the US, and Asia all reopening together. That is going to drive a synchronized global expansion that lasts through 2022, most likely into and perhaps through 2023, driven by the inventory restocking, right? For all the supply chain stuff, remember, the inventories need to be rebuilt. And so that's very, very good for growth. strong consumer demand, right? The household net worth we just talked about, record all-time high in the US, very strong wealth gains in Europe as well. So the consumer globally is in very good shape. And then third, a CapEx boom designed to deal with climate in part, designed to address the supply chain issues, designed in part to provide production facilities in each of the main three regions, right? Electric vehicle batteries in Europe, semiconductor plants in the United States, et cetera, et cetera. So I'm of the view, and this is why I remain constructive on equities and commodities. Nothing that's happened in the last couple of weeks, in my view, has derailed that big, strategic driver of a synchronized global expansion. If anything, in my mind, the data and the outcomes of Asian reopening, et cetera, are bullish and constructive for that strategic synchronized global expansion to take place. So that's the thing that I'm focused on there. And then to get to the transitions, I see four. The first we've already talked about, the big overarching transition of going to a low carbon environment. That's key. But then there are three market transitions that I think we're entering into that are important. The first is the shift from liquidity-driven markets to earnings-driven markets. I think this is why the supply chain concerns have gotten people so exercised, kind of as a market story as opposed to just a sector or stock story, because people are worried about margins, because we are shifting from liquidity-driven markets, even though financial conditions still remain very, very easy. But we are shifting to an earnings-driven market. And again, we are coming into the earnings cycle. Again, not so much how important Q3 earnings are going to be, but what's the outlook for Q4? What's the outlook for 2022? The second is the shift within equities from growth-driven markets to cyclical value-driven markets. Obviously, that's critical. We've been in a growth-driven market for a decade. We all know what that means in terms of US versus the rest of the world, tech versus everything else, et cetera, et cetera. But remember that as we talked about some time ago, higher rates are a kryptonite for tech stocks, and we've seen some of that play out, obviously, in the last couple of weeks. I think we're probably early in that. I don't expect tech to implode, because they're very profitable. A number of certainly the bigger companies that make up that famous 25% of the S&P, super profitable companies with tons of cash to buy back stock, to increase dividends, et cetera. So it's not going to be an implosion, I don't think. I think it is more going to weigh on the U.S. relative performance as an anchor and weigh on the performance of growth versus value. So I think that shift is going to take place, as I say. That's a transition I think we're starting to enter into. We had a taste of it last fall and last spring. I think this shift now is, if I'm right about that strategic synchronized global expansion, the shift from growth to cyclical value is going to be a sustainable shift, sustainable, let's say for a year or two, as opposed to a quarter or two, which is what we had in the fall of last year and the spring of this year. And then third, and most important, the transition from bull market in bonds to a bear market in bonds. And here, talking primarily about government debt, particularly in the United States, but also I think to a lesser extent in Europe as well. And so here, the 10-year bottomed last spring at 0.5%. It's now 1.5%. According to folks who are technicians, we need to break 2% on the 10-year to convincingly break the 40-year, trend of lower rates that's been in place since Paul Volcker in the 1980s in the United States. But I think we're going to get there. I think we are going to break 2% on the 10-year. Remember, you and I were talking, late last year about my target was 1.8 to 2% for the end of this year. I still think that's a reasonable target. I do think, I don't know whether we'll break 2% on the 10-year before year end, but I do think in the next year, we will break 2% on the 10-year and break that 40-year bond bull market and convert that into a bear market. And so that kind of helps me sum up in terms of our asset allocation in that environment, given what I've just said, shouldn't come as a surprise. Overweight equities, overweight commodities, significantly underweight government debt.
Mm-hmm. Yeah, that's fantastic. This has been it's been a great wrap up in the end. So in terms of the bonds, if we have time, for 1 minute,
Sure.
is how much? And I guess I know what the answer is. I guess it's about 2%. So where is the level that the 10-year can go and still be seen as positive for equities? So
yeah, that's another way of thinking about the same, another way of approaching the same question. I would highlight to folks that in the monthly, which is up on the OHM site, we do have a number of charts. We have one in particular that show this specific outlook for the U.S. Treasury and shows why the trend line as to why we need to break 2%. And I think the question about good for stocks is both a rate of change as well as level, right? So if we continue to move aggressively, let's say from 1.5 to 2 in the next month or two, that's probably going to be a challenging environment for the S&P to do well, because those tech stocks are probably going to continue to drag, right? If we move from 1.5 to 1, back to the highs of earlier this year, I think 1.78 or so on the 10-year over the course of the rest of this year, I think that's going to be perfectly fine. And I do think that, let's remember, it's a twin engine market, right? When rates go up, we've already seen absolutely. It, cyclical and value do well. So it's not really a question, I don't think, of what rate level will send all stocks down, because I don't think we're going to get, I don't think we're going to get to a point anytime soon where the Fed is going to jack up rates directly. It's not so much a level traditionally that ends bull markets. It's a consistent, rise in rates. The Fed is stomping on inflation, rising rates, raising rates, and ending the bull market. I think we're many years from that risk happening in the United States. And so to me, it's much more, rates are going back up for good reason. We're having a robust, synchronized global expansion. That means earnings should be robust. That helps set up that transition we just spoke of. And in that environment, we want to be within the U.S. overweight cyclicals and value and small caps. So very overweight energy, overweight financials, overweight small caps in the U.S. And then outside the U.S., we want to be overweight Europe and Japan, which are more cyclical markets. And then selectively within the emerging markets, as we've discussed, Russia, parts of Asia, Latin America, we now have positions in each of the 3 regions of the emerging markets. And then that heavy overweight in commodities, both fossil fuel, clean energy, and metals.
And carbon,
materials.
And carbon, right?
Yes, carbon is in the clean energy category. But also the metals, we're believers in copper. We're believers in iron ore. And I think last point, this commodity cycle, which I think is just beginning, and I do think it's going to be a super cycle. It's not purely China driven, right? We have to get out of our minds the 2012 to 2015 commodity bull market, which was almost purely China driven. This is going to be global because the demand is coming to kind of create the low carbon environment, which is necessary for every country in every part of the world, which is, I think, a much stronger and much better underpinning or foundation for that commodity super cycle to unfold. And I think we're in the first inning of a bond bear market. We're in the first inning of a commodity super cycle bull market, and we're in very early innings of the possibility for cyclical and value and non-U.S. equity to outperform growth in the U.S.
That's great. So yeah, fully agree. We covered a lot, and as usual, time flies. So
It really does.
yeah,
I must be
thanks.
getting old, or you're really super good with your questions, Roberto, which you are, of course. But wow, yeah,
No,
this
no, I
this got to
mean,
be one of the fastest hours I think we've had. So
no, we do, and
kudos to us
as
both.
always, it's a lot of fun. So again, thanks again. It was great having you, and really look forward to 2 weeks from now, which is going to be October 19th.
Super.
So thank you, and for clients, there's a lot for you to read, in the monthly, and yeah, thanks again, Jay. See you soon. Bye
Okay.
bye.
All right, Roberto. Bye bye.
Cheers. Bye bye.